So the state of the market, the state of the economy right now. We're going to talk about what's going on in the real estate market and the stock market, the pros and the cons, what's leading towards a potential recession, what are some of the indicators that might lead to us wanting to buy right now. But first, just like the state of the market right now, I have a shit story. Um, so I was just coming down here and we were actually moving some tile earlier today. I had my tile guy here and I had some tile in the basement and he left the door open. He was carrying it to my garage, so he left the front door open. And the neighbor's dog, off a leash. I live on a property that's like, the neighbor, the dog had probably around a kilometer just to get to my house, right? It's a good distance. And so there's like farm fields behind me and stuff, and the city's out front. But the dog went into my, I don't know for sure. I know that his shit is not my dog. I know the shit in my basement right now is not my dog shit. It's another dog shit. And I know the dog that did it. I didn't catch him doing it, but 100% it's his. And I walk down and I see this like bunch of little shits on my carpet, which I'm taking out the carpet anyway, so I don't care. But like, just the audacity of this dog. It goes around my property and it pisses in my garage, on my screen doors, all around the corners of the property. And I try to be really nice because like, the dogs are friendly and like the neighbors are nice. And I only have two neighbors, really. Like I really have one neighbor, so I shouldn't, I can't create any conflict, so I can't really confront them about it. But like their dog is just untrained. I don't think it's neutered. That's why I pee so much. I don't know, but anyway, I just almost stepped in it on my way down here, and I was like, "Are you kidding me?" Like their dog came into my house and took a shit. Like not, it already shits on my lawn and my driveway and it pisses on everything. I'm like, that's fine. Like that, that's part of neighbors. Their fence is broken. I offered to help fix it. I'm sure it'll get fixed and it'll all be fine. And I try to be a good neighbor. So anyway, okay, the state of the market. It's shit. It's shit. And so that's why I thought this story kind of, was worth sharing because, sometimes life gives you shit, but you got to make the best of it. And I'm going to talk a little bit about the stock market and stuff too, and what's been going on. So today, some market updates. So IBM delivered great earnings. I like IBM. Netflix delivered shit earnings. If anyone follows that, we're down. They're down 38%. I'm not a shareholder of Netflix at all, other than my exposure to the Nasdaq. I otherwise didn't feel anything at all. But 38% drop on the year. They have wiped out almost 70% of their entire company's value. Netflix is in the shitter. With Netflix came Disney. There's been some turbulence there with Disney. There's actually an opportunity to buy Amazon, Disney, because Amazon's Prime service. It was all kind of like, hey, if Netflix is tanking, maybe the whole sector is. Honestly, I just think that they're a little bit more aggressive in their forecasts than necessarily they need to be. Pretty much everyone has Netflix already. There is a lot of account sharing, and I get they're going to try to jump on that, but like, it'll be fine. The company's not going to zero per se. I'll admit I sold puts today with 190 expiration in the next 30 days. So if Netflix stays above $188 a share, which is like another 20 something percent drop. So if it drops another 20 something percent, then I would have to own shares. Otherwise I get money for nothing. So I did sell some contracts on that. Tesla delivered amazing earnings today. They're up 5% after market, which is about as much as they dropped today. So they're the exact same as where they were at open this morning, I guess, technically, or close yesterday. But the earnings were good. They did exceed despite a lot of the supply chain restrictions and issues like that. Sam shares. I have shares in Sam, and it's got earnings tomorrow, which I'm looking forward to, hoping that they're good. We've had 3 quarters in a row they're shitty. That's just like a long-term hold. And a couple other companies that I follow too. It's honestly, unless you're going to look for the long term, you don't want to play earnings really. It's gambling effectively. So I try not to own, there's anything I'm not super long-term bullish on, I try not to own anything through earnings, because earnings is gambling. Like you could literally just buy calls on like all the top 20 stocks just before earnings, and calls have a stop loss automatically, right? You buy a call, it's worth like say $10 a contract or whatever, and that's the max you can lose because you bought the call. Their expires worthless and you lose the couple of bucks it costs you to buy the contract, or you can make like 10x to 1. So a lot of people buy calls right before earnings, because if it tanks, like, oh well, you lose a little bit, but if it spikes, then you can make like a 10 or 20 or 30x return, depending how many balls you have, I guess, to buy those, how many contracts you buy. But I know some people who make crazy crazy returns in sort of a gamble, and maybe they have some market research behind if the earnings will be good or not. But it's not a space that I play in. I don't trade. I try to invest for the long term. So anytime I get assigned shares, I want to hold them for the long term. I'm trying to mimic my exposure to, and mostly I play the indexes, to be honest. Like I'm mostly trading QQQ, SPY, or companies in those indexes. I try to build a balanced portfolio. Sorry, I'm just having a little bit of smoothie here, guys. I didn't talk about it on the channel, but I agreed to do a 75 hard challenge. So I am on I think day 7 of this 75 hard challenge, which requires me to, I already intermittent fast. So the diet thing was fairly easy. I didn't have to change much there. I already drink plenty of water, so just drink a bit more. And then I have to do 2 workouts a day, which can just be as simple as going for a hike or a quick run or a walk with the kids. I also have a home gym, so it's going to the gym and stuff. So if you've been following my Instagram stories, you know that I am super sore. I went to exhaustion 2 days in a row, and so today I'm just taking it easy, doing light workouts. I didn't no weights today at all, just mostly cardio and body weight calisthenics type stuff. So I am super sore today. The stock market, I guess. By the way, if you have any questions, throw them down below, and I'm happy to answer anything you guys have on the state of the market, whether that be the economy in general, inflation, worries. Inflation's admittedly a lot higher than it is. They intentionally make it look lower than it is, especially when it comes to housing. The categories that people spend 3/4 of their budget on, they tend to make those not look so bad. So housing, transportation, and food, they tend to make it look not as bad as it actually is. So it's significantly worse. The government likes inflation. Remember, inflation is actually a good thing for most developed economies. It helps increase revenue for taxes. It helps them grow your assets so they can then take a percentage of them. And then since the buying power of your dollars has dropped over time, you think you have more money, but you actually have less because the government's actually taken a portion, and all you've done is keep up with inflation. Now, if you use leverage, use the bank's money, or you use other people's cheap money, this only works if it's cheap money. If you're borrowing at less than the cost of inflation, so if you're borrowing at 3% now against assets that can return 8 or 10, or keep up with inflation at real inflation at 15, they're saying inflation's 8 to 10%, but it's really, if you adjust for properly for housing and for transportation and food, it's really closer to so what someone jumped a question here. I'm just gonna tag it out right now. Why am I so bullish? So originally they were at a 30 PE. They had a bad earnings. They were at 15 PE at one point, and over $1,300 a share. Now they've had a couple of bad quarters. They had some write-downs and some products that were not fantastic. So they are a strong cash flow generating company. They've just had a few really bad quarters where they almost didn't make any money because they were focused on some growth stuff. I also I think their weed drinks coming to market will be huge. Their marijuana drinks, people will, the edible market is growing, and I think people want to drink beer/weed drinks. And so I think there's some growth there that they could see, but it's just a cash generating machine that has the potential, I think, to come back to $500 a share. Now I think it was rich at $1,300 a share, and I was actually short the company for a little bit. But then I'm like, you know what? I started looking at what they were doing, and I'm like, they have some really strong customer loyalty. And I feel like throughout COVID, throughout all of this, people drink. And my thesis was people drink, and the people who are mostly drinking tend not to be so price sensitive. They, you're gonna buy, if you like that brand, you're gonna buy it if it's 50 cents more or not. So I feel like they could pass on their inflation issues relatively easily. Now, I could be wrong on that, but I felt like they were a brand that would do that well. Same with Starbucks. I own shares in Starbucks and a few other companies I think could pass on well some of their costs. So I'm just bullish. Again, this is the position is currently 1% of my entire portfolio. So I have a way bigger exposure right now to Intel as an example. I have bigger exposure to Facebook right now in my portfolio. Enbridge, Pembina, the financial bank stock, I have a way bigger exposure. That's just one that I'm personally really sour on because it's the worst performing stock in my entire portfolio. Anyway, yeah, what a day to talk about weed drinks, eh? It is 420 today. So for all those people out there who enjoy to partake, it's a celebratory day today. Oh, I see. I missed a question. So Michael Chung says, when filing an exit return, do you have to sell your stocks, or can you transfer your portfolio to a U.S. brokerage? So My understand, and I'm not an expert, talk to your accountant, but my understanding is when you file an exit return, you pay all the tax you would owe on everything that you owe at current market value. So if your stocks like yours are, Michael Chung, are down right now, then that would be potentially no tax implication at all for you because you hold GameStop and other garbage. I mean, growth stocks. The G got confused there from garbage to growth. Um, no, I mean, yeah, you would have to pay tax on all your. You'd be deemed to have sold your companies at fair market value, your properties, et cetera, so forth. A lot of people, when they file an exit return, they leave the country that they're leaving, will transfer those assets into a corp, and that way they don't have to file a personal tax return anymore because those assets are now inside of a corp. They may still file a corporate tax return and have like a Canadian corp that would hold those assets. That's an option that you can explore with an accountant and figure out what's best for you. But yeah, I think that you basically pay tax on everything. Now, stuff in your TFSA, tax-free savings accounts, and your RRSPs, my understanding, continues to live on even after you leave Canada. However, you cannot contribute any more to them, so your limits do not continue to increase on them, but what you have in it, I believe, can continue to grow tax-free, is my understanding. But again, talk to your accountant, do some reading of your own and find out if that's to be the case. I believe it's the case. That was what I was reading online, but again, I'm by no means a tax expert. So yeah, if you have tax-free savings accounts and RRSPs, those would be frozen. So if you have, $70,000 in shares in a tax-free savings account, then that would, in theory, have no tax implication on an exit return. And you could even pull it out if you want to or leave it. Yeah. Can you transfer your portfolio? So when you do a transfer, it's basically the same, especially when you're changing countries. My understanding is there'd be no advantage to transferring in kind unless, and I'm not an expert on this either, but I believe that there'd be no advantage other than there might be like less fees. Like you could journal, if you had shares on that are on the Toronto Stock Exchange that are also on the, the NASDAQ or the S&P 500 or whatever, then what you'd find is when you transfer them, there's no fee to journal them over, and you go from having shares in Canadian currency to then in USD. It's one way actually you can transfer between currencies without any currency fees. So a lot of people, if they have shares in I don't know, it's a company that trades on both, I don't know, like Sun Life, like a big insurance company or something, then you could go from the Toronto Exchange to the US Exchange and basically there might be some arbitrage there too. Like it might be more than just the currency difference that they're trading. Sometimes stocks will trade like one's at $1.20 and other one's at like $1.40, and it's more than currency at play when you're journaling. But it is a strategy that I used to use back in the old days before there was companies like Knightsbridge that allowed you to trade it. Like basically you can transfer your money at almost par, very very little fees. Never use the banks. Never use the bank to convert. Even their preferred rates, their private banking rates, don't come close to some of the private sector availabilities out there to convert Canadian to USD, USD to Canadian, or any other currency. So just don't use the bank. The bank adds like 3 to 5% on every transaction. So when you go to the bank and you ask them what the rate is, they've added 3 to 5% profit on that. So on $1 million, that's $30,000 to $50,000. I know people who, like older people I talk to, who are buying a property in like Florida, and they're like, "Yeah, I just went to the bank and transfer $1 million." I'm like, that they marked that up 3.5%, right? Like that costs you $35,000 in currency fees to buy that property. And they're like, "Oh no, I thought that was just like the rate I had to pay." I'm like, "No, Knightsbridge isn't even, they're okay. Like they have like a 1% fee, I think. But even that's like 300% cheaper or 400% cheaper. I use a company called Monex where we're able to trade through Goldman Sachs right on the floor. There's a very small jump, but there are lots of other companies who do the same thing and you get in very, very cheaply. You can also do it inside of your brokerage accounts too. So there's lots of ways to transfer. If you're buying like a $2 million property or a series of properties in the US, you should not be using conventional means to transfer funds back and forth. Some people just literally go into the bank like, "Hey, I'm gonna wire $1 million into the US account. Take care of the conversion for me." They'll charge you hundreds of dollars in wire fees, which is like a given, but they'll also charge you tens of thousands of dollars in currency fees. So don't use the bank to convert. There's little things like that, stupid little things like this that people just don't think about. Like they don't negotiate their car insurance, they don't negotiate their mortgage rates, they don't come in and negotiate with their bank. All these things add up to over a lifetime like $1 million or more, and those little things are what has given me an edge. All those little things that I do that, where I'm not afraid to negotiate or afraid to ask for something when others are afraid. That has served me very, very well in my life. And so that's something I recommend everyone do is just always ask, is there a better way to do this? And spend a little bit of time. Sometimes that time's worth $30,000 an hour. Someone asked here. Washer dryer money. What do you think about the option trading wheel strategy, selling cash covered puts and then turning around and selling covered calls when it's put to you? So in general, and I've spent a lot of time testing this, talking to people who back tested it with data and who are better traders than me. Admittedly, I spend like an hour a day looking at my trading portfolio. So I don't do the proper market research. I will sometimes read other analysts' reports, but in general, I try to just copy the market. I try not to time the market because none of us has a crystal ball. Anyone who says that we know the future doesn't. You can try to make educated guesses, but at the end of the day, you're just guessing. No one knows whether it's going up, down, sideways, whatever. No one knows. Yesterday was like a 2.5% up day at one point, and then today down 1.5%, right? Like one Netflix news crashed the market. Now probably Tesla's news will throw the market into, yay. We don't know. No one knows. What we do know is that every options trading and stock trading analysis technique has been back tested, and every trading algorithm, bot, etc., has been built. Pretty much all of them have been built already, and they know how to run. When delta equals, or say when theta's over a certain percentage or whatever, they can execute that trade better than we can. And there are people who do this with full teams that run 12 hours a day with expert market research who don't outperform the market over a 25-year time horizon. In fact, of the expert traders, 99% do not outperform the market. 1% do. Maybe you're the 1%. Maybe you want to spend 14 hours a day becoming the 1%. If you don't want to spend 14 hours a day and get up at 5 in the morning and start reading reports and go to bed, after market closes, spend another 4 hours, you don't want to make that your full-time job. If you want to be retired or do it as a part-time side hustle thing, don't expect to outperform the market, period. So wheeling, what you'll gain and save in your cost base by wheeling, because when you get assigned shares that are $100, you get them assigned at 98. You see a 2% discount or whatever on the shares you're buying. But every time that happens where you get assigned, you save 2%. There's also those other 2 times where you don't get assigned and the shares run up from 100 to 110. You miss that whole gain. So when they test the data, what they find is that most active traders, even running the wheel strategy, don't outperform the market over the long term. But it produces, if you run it properly and you stay way out of the money, you can set it up such that you have insurance and stability. So the advantage, I think, that sold me on the wheel was, one, potentially there's a tax benefit. Now, it depends how you look at it. For me, who is planning to leave Canada, there actually isn't a tax benefit. Trading inside your personal name is considered active income, meaning you don't get the capital gains exemption. If you hold shares of Tesla for 1 year and then sell them, and you have $1 million gain, hypothetically, 50% of that gain is tax-free in Canada as of right now. That's going to change. They're going to increase it to 75%, so that you only get 25% tax-free. But right now, 55% of all capital gains are considered tax-free. The other half are taxed at your marginal tax bracket. What that means is about 26% of that gain gets taxed. When you options trade, let's say you sell a put on Tesla, and then you roll that, and you roll the contract again, you sell it, then you run the wheel on it, you sell calls on it, you get the shares called away, you only own the shares for like a week, and then another contract for a month, and you have like 30 contracts, and you're chasing and basically running the wheel on, say, Tesla, just as an example, because they had earnings today, and they're top of mind. By the way, props to anyone that's holding shares in Tesla. Super bullish. I think the company is slightly overvalued, but they are just a train to be reckoned with. Like, no one wants to short that company. They're just so innovative, and Elon's just such a savage that I have mad respect for what he's doing, and I would never short the company. I had shares, I sold them. I might get back in if we see it drop back to like $800 again. Anyway, but the point I'm trying to make is, if you did that other strategy, you'd be taxed, and let's say you're a higher income earner, so you're at like the top marginal tax bracket. You don't get that 50% of it tax-free. It's active income. So in your personal name, when you're running options, you're taxed, if you're in the top marginal bracket, at 56%. Whereas capital gains max out, because half of it's tax-free, max out at 26% effective tax rate. So it's half as tax efficient to trade options. That's just a fact. Now people say, okay, go in the corp, do it in the corp. It's an active business. You can write things off against it. That's true. You can. If you're actively trading like that every day, you can build a business around it. You can hire a receptionist, write your home office off, et cetera, so forth, and have a whole bunch of deductions, go to stock trading conferences and write all that off against that income. So it could be a business and you can get some write-offs against it. Okay, that's true. Also true is the fact that, and by the way, in Canada, the first $500,000 of active income inside your corp, if you have no other corps, this is combined for all your corps. So you have a landscaping company making $300,000 net, and you're making $300,000 in your options trading corp. You're going to be over that $500,000 limit. So the first $500,000 is taxed at 13% inside of that corp. That's an advantage. Like, that's what sold me on options. Is like, hey, I can defer some tax. It's a great way to build a trading portfolio inside of a corporation. That's how I do options trading. I also have a passive holding arm too, and anything personally I would hold, again, passively, because I want those capital gains tax treatments. But when you leave Canada, this is what I didn't know, when you take that income out of that corp, you don't get hit just for the 13%. You get hit again from a personal income tax perspective. It's considered active income. You pay yourself a salary or whatever, you're, again, getting a huge amount of tax, or even dividends, again, like you're looking at like 40% tax rate. So it's less preferred than capital gains tax treatment. So it is taxed worse to actively run the wheel on Tesla versus just buying shares and holding. Just a fact. So tax treatment's worse. When you run the data, what you find is that it depends. The wheel can outperform in periods of drop. It performs better because your cost base is lower. In periods of flat times, again, the wheel performs better. In periods of strong bull markets, it performs worse. So I think over the next 12 to 24 to 36 months that the wheel strategy will work better because we are in a down market, or at least a flat, volatile market. And so for that reason, I continue to options trade. But long term, I don't plan to be doing stock options trading. In a bull market, I don't want to be trading, actively trading. I want to just own the market and let it ride. When you miss those rides, that's where you lose most of the gains of the S&P 500. So, like the average, 10% a year. There'll be years where it's up 25%, and the wheel guy won't be ahead because they'll have missed out on a lot of that, waiting to get assigned on those contracts, or having their shares called away in many cases before the top profit they could be sort of unlocking. So hopefully that answers your question. But that's talking to a lot of really smart people who have better data than I do. These are guys who trade on Bay Street and Wall Street and who are in the industry and spend 12 to 14 hours a day, who have extensive experience in derivatives and options trading. And I don't. Like, again, I know how to, I play around with it, but I spend a couple hours a day. These guys spend like all day, every day, with teams of people behind it and bots that literally run. Anyway, so they have a way better data set to work from, and they can actually back test, does this work over the last 12, 24, 36, 5 years, 10 years, 25 years. And just in general, guys who work on Wall Street, who run hedge funds and mutual funds, net of fees and taxes, net of fees do not outperform the buy and hold of the market. So you want a positive delta that mirrors the market. That's it. Period. If you want to grow your wealth fast, the fastest way to grow consistently with a highest probability of expected return is to invest in private businesses and treat real estate, again, like a private business. I think building a business around real estate is one of the best and safest ways to build wealth, with the least amount of downside risk and a fair amount of upside risk. Again, cheap leverage is another great component of buying businesses. But you can do that with interactive brokers too, right? Like, you can borrow it right now, still under 2% interest, like 1.5% interest. So I still think everyone should have a stock portfolio, and they should borrow against some of their stock portfolio and lever that into real estate. So I still think it's a component of someone's wealth, but again, all of your wealth should not be in the stock portfolio unless you don't want to do anything. Like, if you are like, hey, I don't have any gifts, I don't want to spend any time exploring those gifts and giving those to the world and buying businesses and transforming whatever, and I don't want any diversification that way, I just want a balanced market approach, okay. I can see the argument for having just a stock portfolio. There's some allure there because it takes a lot less time and effort. Good to hear about Intel. I also like Intel. I think my cost base is like right around break even right now. So Kyler says, hey Mike, keep up the good work. Thanks. Tristan says, any advice for crypto miners? I started in July 2021, looking to expand. Well, proof of stake for ETH, or ETH 2.0, is coming. They delayed it again. So my forecast or guess would be sometime for January. And again, I don't know. None of us know when it'll go to 2.0. Then there's ETH Classic, which you can continue to mine. There's Flux, Ravencoin, Litecoin, Dogecoin, a million other coins you could mine as well. But suffice to say, the cards are depreciating in value. The premium we were paying, or people were paying for cards and for graphics components, is going down significantly. So if you bought a bunch of rigs in December, you've probably those rigs have depreciated faster than you've mined. So you've actually lost money. The amount you've mined is less than the depreciation. So it's a shit time to be a miner right now. Also on top of that, like Bitcoin and Ethereum has had a pretty shit year. Just crypto in general has not done all that well. I'm extremely bullish on ETH as it transitions from proof of work to proof of stake and to 2.0. I'm bullish on Bitcoin too. As soon as the large funds like the hedge funds and the pension funds and all that can start allocating, say, 1% of their portfolio to Bitcoin, just like they do gold or whatever, like I think that's going to be part of a balanced portfolio. Once that's the case and the regulation allows for that, the market share, I think, will take Bitcoin to over $100,000 USD per token. I'm bullish. Again, Bitcoin mining too. The hash rate, if you read in some of the forums right now, is increasing in difficulty and complexity at 7.9% compounded a month. So it's very difficult to, it used to be you could buy a Bitcoin miner and you'd be paid off in a year. Now it's getting closer. If you map out how the hash rates will continue to change and come online, more machines continue to come online, which makes it more difficult and makes it harder to mine. So you get less of a reward for everything that you mine per terahash. But it's about 18 to 24 months payback. You still own the machine, but you could sell for some money in theory, especially if Bitcoin has a big bull run. But if Bitcoin, so basically, if you believe Bitcoin will be declining slightly, flat, or a small amount of appreciation, you should do Bitcoin mining. Invest your money into machines and mine it, and you'll get to dollar cost average basically into Bitcoin. And you can just hire a hosting company like Compass or any of the other ones you can call up that will host it for you. They'll get cheaper hydro rates and they'll just host it for you. It's better all around. Or if you believe Bitcoin is going to go from $40,000 a token to $100,000 a token, and you actually believe that in your heart, don't buy any miners at all. Put your money in Bitcoin and wait. You just make way more holding the token than you would mining it. So mining works best in situations where it's flat. It's kind of like trading, really. The only time you want to really run the wheel or run the options trading wheel is if you believe the market will be sort of sideways, down, or sort of like small upward trajectory. If there's a big run up, you just want to own the equity. So yeah, I like dollar cost averaging. So I think it's maybe smart to, and I have no idea what the price of Bitcoin will do. It could trade sideways for another year and a half. 2024 could be the next, halvening cycle where we have, it just goes insanely, 10x, who knows, right? But anyway, I think that there's definitely opportunity in the space. So in general, to answer your question, I like mining. I follow some of the bigger miners and they have economies of scale and they can do it more efficiently and better, and get their components at a cheaper cost base and get their hydro at really cheap cost base. So there is advantage, and I like Riot and Mara and some of the bigger Hut 8, as in is a Canadian one that operates out of Alberta and Quebec, mostly Alberta, and they do a ton of mining too. So they're a great stock if you want to get exposure to that. I think Hut 8's a great buy right now. You can sell puts on it and likely get assigned or get money for nothing. The puts pay really well. So if you don't want to necessarily own the shares, you could just sell puts on the down days, and that could be a way to generate. The thing I like about options, by the way, though, is that you can generate yourself like between a 6 and a 12% return with almost no risk. You can set up your contracts where you're exposed to the market, but you need a 30 to 40% pullback in the market, which is like full on recession, burning in the streets kind of level of like collapse before you're assigning the equities, in which case you hold the equities and you just wait until it comes back. You can set that up so you can make like a 6 to 12% return, which will beat inflation inside of an options portfolio. And I have to check on that every once in a while. It's a bit of work, so I don't know. It's slightly preferred to private lending, I guess, from a tax perspective, depending on which country you're in. I don't know how the US treats it, but in Canada, it's slightly preferred because you get more deductions against it. But I don't know. Private lending is just easier at the end of the day. I believe we're going through a flat or declining market in the next 12 to 24 months, so I continue to options trade. I also just am enjoying testing my thesis out to see how I perform. If you adjust for the two stupid trades, which are not wheel trades at all, I deviated from my strategy entirely and shorted, naked shorted. If you negotiate or remove those from my trading history, I've outperformed the S&P 500. But what I know is that I don't spend 14 hours a day reading and developing some sort of competitive edge. In real estate, I can develop a competitive edge. I can call 100 grannies and someone will sell me their house for 50 cents on the dollar. I can make connections with all the wholesalers in a market and cherry pick deals that are better because the market isn't efficient. The stock market is efficient. There are people arbitraging it constantly. Whereas in one market, in real estate, there's no experts. Like there's a bunch of mom and pops, a bunch of stupid realtors with bubblegum licenses. It's just an easy industry to develop a competitive edge in. Again, like you can find a contractor to do the work for half price of another contractor. There's so much arbitrage and you're in control of that business. In the stock market, you have no control. Like Netflix could be a great company. They could have great management. I don't necessarily think that's the case, but let's just say they did have great management. And then today, earnings comes out and they miss on earnings and it's down 38% on the day, right? Like you have no control over that at all. And what's worse is funds or sometimes retail groups of traders will push stocks to exacerbated highs and lows. And it's hard to predict what will happen. In the real estate market, it's much more smooth. And when you can look at the comps, imagine you can look at Netflix shares and someone's selling their shares for $150 a share. And you're like, the market price is $220 right now. And like everyone agrees the market price is $220. But someone over here is selling their shares for $150. You just go buy those. And like maybe you need to like polish the shares. Like they're just a little dusty, like clean them off, boom, put them back on the market at $220. That's the real estate market. It's not efficient at all. It's full of arbitrage. So that's why I like real estate. But the same thing with businesses. A business owner's been in the business 30 years. He's frustrated. He's tired. She's tired, whatever. And they just want to be out. And they're like, hey, I just want to sell this business. And sometimes they'll sell the business fully financed. Where can you buy shares? We're like, hey, I'll give you my shares and I'll finance them. Or you have to put 10% down or something, right? Or the bank will finance you to buy the shares. Now, I guess with Interactive Brokers, you can get your shares financed, 70% loan to value. So in theory, you can do the same thing with shares, but you just don't have the same control. Like in a business, I can go in there and I can make some systematic changes. I am management. So there's a chance to outperform. If you're going to just buy the market, then I think avoid real estate. If your strategy is like, I have no skills, I plan to just buy property on the MLS from Joe Blow Realtor, and I'm not going to do research, I'm not going to renovate it. I'm not going to get any competitive advantage in renovation. I'm not going to have any competitive advantage in finding a deal off market. I'm not going to manage it any better than anyone else. There's probably not a huge amount of advantage for you to go into real estate. Same as a business. Like if you don't want to run a business, you're going to like let the business run itself and run it to the ground. Probably don't go in and buy that business. If you're the type of, and I know some people like this, you're the type of person who doesn't spend 10 hours a day. You're just not that grinder. You're not self-motivated. You might buy a business and lose your shirt because you're not giving it the attention that it needs. And so in some respects, it depends on who you are. Like people ask me, hey, what's better, Mike? Stocks or business or real estate or lending? I'm like, let's talk about who you are. What's your risk profile look like? What do you, as a person, are you someone that's a type A motivated person, or are you someone who just mosses on the couch, right? Like it just depends on who you are and what state of mind you're in too, right? Like there's been times in my own life where like all I want to do is just be a cinephile, where I think that's what it's called, cinephile, where you just love watching movies and analyzing them. Like I just wanted to watch movies. It's one of the things I love the most is like chilling and watching some great cinema. But there are times when I feel like just growing like crazy. Yeah. Someone says, Tristan had some valuable advice I'll share because it's related to the topic right now. PSA for everyone. If you're not ready to drop everything and work, you're not ready to go on your own. A lot of people I know worked for a great employer, made great money, and were like, I'm going to go on my own and be a contractor. And then, this is someone I know who did the contracting thing, and then failed. And then went back to working for someone else because they realized that they couldn't do the billing. They got lost in the accounting and the billing, and they were misbilling, and they were losing money left, right, and center. They couldn't manage the guys effectively. They were kind of the kind of person who couldn't be hard on their employees. So they couldn't run a business in construction. They were great contractors, carpenters, but for someone else that had the systems in place. And maybe someone might say, hey, it's a lack of skills. And hey, that's probably true. They were lacking some skills. But not every personality type does well with entrepreneurship. Some people want to get home at 5 o'clock and have beers and just chill. And they're about their family and they're about other things. And that's okay. There's nothing wrong with that. Not every investing strategy works for all people. And for some people, just literally you could just literally, on down days, you could literally just sell puts close to the money on the indexes, like the S&P 500, and be exposed to everything because you're exposing yourself to Brazil, Russia, India, China, and the S&P 500. You could buy all the different, like VTI is the world index, right? You could expose yourself to something like that. And on the down days, when there's 1.5% down, those options contracts trade at 20, 30% discounts. So in theory, on the really down days, if you just sold them on the next big up days and then got back into the next down days, you could generate yourself like a 12% annual return, which is nothing to sneer at. It, over the last 5 years, that'd be underperforming the S&P 500, but still is 1% a month. That's pretty good. Some people, I know people who have gotten into real estate too, who have messaged me and be like, Mike, I bought this property. The contractor took me for a ride. I'm a nice guy. So like, I didn't say no. The contractor wrote up the bill, an extra 50 grand, said they were going to sue me. So I just paid it and lost money because I over renovated and the contractor took me for, by the way, contractors they always will skimp on work, or like, not always, but on Kijiji and Facebook, the contractors that you'll find there, or the ones that are available to work for you within less than 3 months notice, which is like, most real estate investors are like, I need to find a contractor. I'm closing the property in 2 months, and they find someone. And that person that's available to start your project probably is available for a reason, because they're shit. And not all of them, but many of them don't know what they're doing. And so you'll get skimped on quality, you get crushed on price, or you'll get bad reliability, and so your project will take a year to finish, and you get crushed in holding costs and the opportunity costs of money. They get into real estate, and they find out that, hey, Mike says it's great, and like all these people online say it's great, but like I didn't make any money doing it. And you don't always make money. Sometimes that happens. But yeah, I would say that in general, it can be a difficult business to make money in. And if you don't buy smart, you can get crushed. And if the market conditions turn away from you and you sell at the wrong time, again, you could lose money. It's a business. It can happen. That's why we try to buy properties that we're going to hold for the long term. We're not focused on a short-term exit. I've never been focused on the flip. Flippers get crushed in down markets. That just happens. It's a fact. Buy and hold investors who are buying cash flowing positive properties. Buy them to flip, to burr, but then refinance them, pull most of the money out. If you can't pull all of it out, pull some more out later. You're holding it for the long term, and you're built with cash flow to service the debt, and you can continue to hold that asset. That's a win. That's what I try to build my business around, is like the worst case scenario is I'm stuck with a great asset that's renovated nicely to the way that I want it, that's positive cash flow. So in any market, that would be my advice to you. If you're going to go into real estate, you're going to do that. And if you've had a loss, by the way, analyze where you went wrong and do better next time. Try again. But if you decide that, hey, you don't even want to do it, you don't have the energy and the willpower, whatever, okay. Yeah. Someone made a comment, said, hey, Mike, yeah, contractors are overpricing everything and they are crap. Quality, price, and bad reliable won't answer even text or calls. That is very common. A lot of contractors are like that. And what's worst is when you get a permit and their work gets inspected and it fails, and they're like so embarrassed to come back and redo their work that they just ghost you. That is a very common thing that is a very common thing when you're focused on price, like I have been. So my number one focus was always to get it done for less. And because my focus was cost control, I'm always like, the thing I'm getting tested on is quality and reliability. Because I've already found the guys who are, who meet within my budget. But the guys who meet within your budget, 2/3 of them suck at the quality or suck at the reliability. They don't show up when they say they're going to show up. They'll just ghost you. And the next day they won't show up. 2 days later, they'll show up again. And sometimes I've even hired the guys who are expensive and they still don't show up. So it's just, you get a quote for 30 grand. It comes in 60 grand midway through the project. And they're the only ones who know the project. They already are halfway through. It's hard to fire someone and bring someone else on to take over their job when it's halfway done. There's a lot of inefficiencies when you change contractors midway through. I've had to do it before. It's not great. So anyway, I've got some good contractors too. There's nothing wrong with that. When I pay really well, I get really good contractors who do great work. The problem is some of these projects don't have enough margin to pay the really expensive trades. Like the $100 an hour plumber, he will always show up. Look, not always. 95 out of 100%, 95% of the time, the plumber that's $100 an hour will show up and do the job to code. It's his apprentice that apprenticed under him for 4 years and then went off on his own, that's like 30 years old, who has some bit of a drinking problem on the weekend, that also has child support payments and is behind on 10 jobs. They'll come in and do it for $30 an hour for you. And they might do a good job too. They might even do it to code, but they might not show up for like 3 weekends because they got drunk one weekend. You paid them on Friday, so they said they were going to, but you gave them money. So like in their defense, they got high and drunk and then whatever on Saturday. So they didn't show up. They're too embarrassed to show up drunk. So they just didn't show up, whatever. That's life. Humans are shit. In general, half of humans have a below 100 IQ. The midway point is 99.8. So 50% of people you deal with have a double-digit IQ. I try to remember that because like there's a thing, right? You can only really deal with people within 25 IQ points of yourself. And it's frustrating. So like the most successful people and entrepreneurs, et cetera, in the world tend to be people about 125 IQ because they can deal with the average person and they can deal with really smart people too. They can deal with everything. That's kind of where you want to be because I think it's 30 points, people say. 30 points. So you can deal with someone with 95 IQ. Anything below 95, you're like bashing your head against a wall. But in the trades, plumbers breathe in a lot of nasty glue. Have you ever smelled plumber's glue? Painted for a while, smelling some of that paint fumes. It causes brain damage. You've been in the trades a long time. Some brain cells are typically the people who are good with their hands weren't good with their brain to begin with. Not always. I've got some really smart contractors, by the way, so I'm not trying to generalize, but like, yeah, a lot of the tradespeople that I've met are really good with their hands, not so good with their heads. And then 30 years of, breathing in fumes on job sites has also probably not helped. So you're dealing with a different type of breed. But anyway, yeah, ABS glue is a good time. I've been in a room with a plumber, doing that ABS glue without a mask on, and like, I gotta say, I started seeing hallucinations almost after a couple hours in. Yeah, it causes real issues. But anyway, that's the trades. It's tough. They can't find anyone to work in the trades because who wants to work in the trades? It's shit work. Like doing demo and like framing and working with your body. It's hard. You only get like maybe 30 good years out of your body doing that. So it's anyway. There's a real need for good quality tradespeople. A lot of them are hacks, and the good ones are booked solid. So if you find a good one, don't share their number. That was another mistake. I had a really great contractor once, and I shared their number, and other people I knew started using them because I was like, oh yeah, use this person, they're great. And then they couldn't keep up with my work. My project started sitting, and they were an amazing contractor, but just they had other people call them and be like, yo, you do a great job with mics. Like, what if I give you like 30% more? Will you just come do my house? Like, I don't care about price. I'll just come do a good job in my house. And then I lost them on a good project because I shared them. It's like someone asked me for a trade contact. I'm like, you might as well just literally just call me and ask me for $500 cash. You have a better chance of me just giving you $500 out of my wallet for fun than giving you trade contacts sometimes. It depends. Like if I'm not using that person all the time, like they're a plumber or electrician, okay, I don't care. I only use them, a couple times a month or whatever for jobs. But if they're your main carpenter or something, that was a mistake I made once. Learn from my mistakes. It's a business like anything else, and it's tough. In the trades right now, there are a lot of real estate investors and a lot of people doing flips and stuff, and not enough contractors to go around. And so the bad ones can charge high prices too. It's a supply and demand issue right now, for sure. Thumbs up. Thank you, Steven. It says thumbs up video. Let's go, Mike. Thanks. Appreciate it. Anyone who's watching this, just hit the thumbs up button. I'd much appreciate it. The person says word. Why having a full TFSA if using margin? Why not put your money from your TFSA in the margin account for a bigger use of opportunities? Sorry, my question is not well formulated. So I think it's because your name sounds very French, so maybe English isn't the first language. But you cannot leverage your TFSA. Although they take it in private banking, they will take it under consideration in the loans that they give you. So in theory, you can technically use it as leverage, but legally speaking, I think most trading firms can't use the tax-free savings account for leveraging. So it's an unlevered account. You make a great point. You can't lever it, but it is tax-free. So if you bought just like Bitcoin funds in TFSA and at 10x's, and it goes from 70,000 to 700,000 balance, that's all tax-free. So that's the advantage behind that account. You then also have margin open accounts, which you can leverage. 3.34 to 1 is the maximum leverage. The reason you wouldn't want to ever use all that leverage is because unless you had really good insurance contracts set up, like you were either buying put or selling calls deep in the money to protect yourself on those equities that you owned, that would pay out extremely well in the case of like it moving against you to cover your margin requirements. Then otherwise you get a margin call. When the market dips 5%, they would liquidate your shares automatically, which is not great. The time where they force liquidation is the time where the market's being beaten up the most. And when there's the most fear in the market, people are the most irrational. The best time to sell your shares is when the market is most euphoric, when you feel like a recession is never going to happen. A day like yesterday was very euphoric. I closed 1/3 of all my positions yesterday. I'm thankful I did because today was a nice down day. That was just luck more than anything else. I can't time the market better than anyone else, but typically on average, if you exit on those big up days and you get in on those big deep down days, especially a second day in a row of big deep down, you tend to be doing all right. By and large, that's served me the best, is when there's the most fear in the market. That's when I like to get in. So yeah, hopefully that helps you. Yeah, margin is good, but it can be a double-edged sword. It could turn, if you're levered, I was levered 2 to 1 on the NASDAQ, and most of my exposure matched the NASDAQ 2000. And we had NASDAQ's down 16% year to date. So right now, if you're invested just in the market, in the NASDAQ, you're down like 16% year to date. But if you have 1 times leverage put on, that becomes negative 32%. If you have 2 times leverage put on, that can become like, again, we're talking like almost negative 50, 60%. To come back from negative 50%, you need 100% gain. You need the stock to double. You lost 50%, now you need to double to come back. It's hard to come back from big losses, so know when to cut your losses, especially when you're using leverage. I made that mistake when I was on vacation in Florida, and I think we had a 6% pullback in February where I wasn't even really watching my account, and I was levered 1 time, so my Interactive Brokers account. And so that 6.5% drop cost me 13%. I need 26% to come back. Now I will come back, of that I'm confident, but it sucks. Like my 2022 year is ruined now because I had leverage on and I wasn't watching in February. And I was not well diversified. Well, I was pretty different. I was basically a NASDAQ 2000, which again, like if the whole market takes a shit and you're levered, you're going to feel that. I didn't have any insurance put on at that time. I didn't have any bought puts. I had sold calls on the equities that I owned at that time. A lot of them are puts that I got assigned, which is cool because I wanted to own those contracts, but then I continued to own the equity without selling anything to protect my downside. So just in general, I waste too much mind share, just my mental energy on trading, that if I just spent, someone like me, if I spent that time productively on building a real estate business or in any other business that I could develop, I can make $10,000 to $20,000 an hour probably. Whereas in the options trading thing, I'm making like $100 an hour. So it's actually not a great use of my time to trade options. It takes away, even though like yesterday, I made $100,000 in 1 day and I locked in 40,000 of that. People are like, wow, you made $40,000 in 1 day. Yeah, but like if I had spent that same mental energy over the last couple of weeks, I probably could have made 400,000 or $1 million in real estate, right? Or in building a business, right? So for me, that's been the challenge, is like it wastes a lot of my mind space. And in general, I know over the long term, I should only perform as well as the market. So any energy I put in should only net me over a 25 or 30 year time horizon, the same performance as the market. So I might as well just buy the market and not look at it. Buy some stocks, let the experts manage what's in the S&P. The top 500 companies, they're sorted for you. The bad companies get kicked out of the top 500, right? So you can rebalance every 6 months or a year. Log in, look at your portfolio. If you bought Tesla and it tripled, now your exposure to Tesla is a large percentage of your portfolio. Sell some of that off and rebalance it. Net of tax consequences, and spread your money out. But be diversified, and you be safe in the long term. I'm not comfortable giving my net worth out. It is significantly higher than what it was when I retired over 5 years ago. Yeah, I'll just say that. Significantly higher. I have 10 times the passive income that I did when I retired. So if I were just to stop doing everything now, I make 10 times what I need to live. So I have a 90% savings rate on my passive income. Yeah, I'll say that. My wife doesn't want me to share. I'm not going to answer that question either. If I stay over, then yeah, I'm not going to say. Yeah, I'm not going to say. If I stay over, then people are like, wow, it makes all this money, and my wife would not be happy making us the target. If I stay under, then I just don't want to say anything one way or the other. You just have to watch for yourself and follow along. I have a goal I'm 29 right now, and by the time I'm 34, I want to have 100 million net worth, and by the time I'm 45 to 50, I want $1 billion. I realize that at my current growth rate, it will happen in my lifetime. Like if I just sustain my 12% CAGR, compounded annual growth rate, I will hit billionaire. It's a fact. Like with some leverage, I'll become a billionaire. As long as I don't fuck up and I continue on a growth trajectory where I don't lose money in something stupid, but diversity should help me to not do that. Then there's a real possibility that I can be a billionaire. And so for me, it's hard to want to, like on one side of my brain, I'm like, I just want to retire and spend time with my 3 kids, my wife. I have a beautiful family. I have amazing friends and people around me. And I'm just so thankful for the opportunity to support, like my dad lives in one of my rental properties. My mom lives in one of my rental properties. I support a lot of people in my family. I'm thankful for the opportunity to be able to do that. But at the same time, like it's a wasted potential if I just go enjoy my life. And so I try now to do here's my potential, here's where I'm going to try to get to, and here's where where I'd like to be net worth wise. It's not all about money, but I want to get closer to my maximum potential. Not all the way there, because I understand that like to unlock my maximum financial potential, I'd become a bad dad, and I might not be a great husband anymore, and I might not be the best friend to some of my friends, and I might not be the best son to my parents, et cetera, so forth, right? Like there's a balance there, and so I try to walk that line. But the type of person that I am, I can't sit back and do nothing. I need to play with the growth. I need to be exposed to something that is both fulfilling and where I can win the game. So how many burrs? Never enough burrs. Ideally, I have a business that burrs without my involvement, where there's a nice acquisitions team, a nice management team. That's coming, by the way. You guys stay tuned. This channel, I think, could be instrumental in that plan. We could use this channel and this audience to tap into, there's potentially like, I started a group, a multimillionaires group, and I just like with friends in my Instagram network, put together 200 people with an average net worth of 3.5 million, roughly. Between 2 and 4 million, most of the people were in that range. Some people had 10 or 20 in that group. But in that small group that I put together, there's collectively like, let's just say like, everyone just had the minimum amount of net worth to be in the group. So like we're talking 200 people at $2 million is $400 million of exposure. There's probably really $1 billion in capital there, just in my small circle. Imagine if we pooled together and built something really cool. That would just be, I don't know, a bucket list item. I just want to, it'd be so cool to have $1 billion in like $1 billion real estate fund, or $1 billion in real estate with some friends. That'd just be cool to do. There's no, like, my lifestyle doesn't change all that much. I mean, I guess I would start flying private jets or something if I got to a certain level of net worth, and that'd be cool to do. But it's a game. It's literally a game. At this point, like, my family is taken care of. Even my kids will be fine. I can say that it's like so that they have every opportunity possible. Like, I guess in theory, I think it's a very likely possibility that we'll be able to live to be 200 years old. I've said this for a long time. I've said I'm going to live to be 200 years old, like, since I was like 12 years old. People know me like, Mike's never going to die. That's like my thing. I believe in like health, but more importantly, I believe that science will allow us to live for a really long time. I believe it'll be the rich who have the opportunity to just, when it first comes out, it'll be really, really expensive. And it'll only be the rich who have the opportunity to optimize their genetic makeup or get, new organs put in, et cetera, so forth. So I want to be rich enough that when that time comes, I'm starting to age really badly. And I have like, I'm 29, so like maybe 40 years left before my body starts to really deteriorate. My grandpa's 85 and like he still hikes and walks and does the Bruce Trail and stuff. So he's got good health. If I can be anything like him, then I have like maybe 45 years left before my body starts to become deteriorating to old age. 50 years, let's call it. So I have 50 years left to accumulate enough that 29, so like, let's call it like, I don't know, 79, I'll say. This is like the age where probably I'll start to depreciate a bit. And I want to catch it before that, right? He does sections of the Bruce Trail. So like he'll do like 2-3 kilometers with his walking buddy. But anyway, in great health, right, as an example. And yeah, I really want to live a long time. And I think the billionaires will be able to live to be 200. And so it'd be kind of a cool goal to like, that's something worth pursuing. Living an extra like 50 to 100 years, getting an extra free life is something worth pursuing, I think. And if while doing it, you can help other people get there too, and you can all win together, to me, that's huge. That's awesome. Okay, I'm gonna go lightning round because I'm behind on this. Thoughts on technical analysis and trading. Liam, in general, TA is, I think, the least respectable way to trade. Technical analysis is the least reliable, so to speak. The most reliable, in my opinion, if you're gonna ask, there's really 5 main valuation techniques. But my favorite is like approaching it like a value investor does. Looking at earnings, power value, EPV, looking at net asset value, and saying, hey, is there real value in this company? What do the assets on the book look like? Is it generating positive cash flow, positive free cash flow? And then how is it investing that and returning a positive return for its shareholders on that cash flow? Most growth companies don't fit into this metric. Some do. There are growth companies that do fit into this metric sometimes. But for the most part, it's value companies that fit in there. So in general, that's the most reliable. That's Warren Buffett's style of investing. TA is very unreliable. There's a lot of human psychology components, which are always changing, There's a lot of like trying to predict what the market will do because it was going up before, it will do this in the future, or because it did this in the past, it will do this in the future. And what we know, the first rule of investing is past does not predict future. And so technical analysis is not very reliable. People talk about like, oh, it's a breakout trend and like whatever, and like, but the thing is like you can just stop the line and like try to predict where future's going to be. But no one has any idea really. You can use it as a tool in your tool belt. Like certain trading patterns can help you make educated entries and exits, but they don't help you make great investing decisions. So investing solely on T&A, so technical analysis, is a investing strategy. So when I see people who have these bot trading programs or like, and make all this money, it's just not, I just haven't seen any data to support that being a great way to invest, period. And like I have a finance degree from one of the top business schools in Canada, and we studied this. I'm pretty sure there is not any real advantage to trying to predict the future using technical analysis, but it can help you with your exits and it can help you with your entrances too. Negotiating mortgage rates, just get a quote from another competitor and then shop that against another competitor, and they will fight on their rate. So you say, hey, BMO just offered me 2.5. Scotia says, oh, well, we're offering you 2.79. I'm like, well, do you want my business? Match it. Beat it. And they do. They come back and they beat it often. So just having a quote will get you to beat their price. Even if it's like the lowest you've ever seen, you can always get a better quote and they'll beat it. Ratespy.com is a great place to look for rates. They spy all the rate companies, so you can go on there and find out who to contact for the best rates to start, and then use that as your quote. Good evening, William. Yeah, it's getting nicer after the snow. What corporate structure could you use? Well, you want to avoid double taxation, so talk to your accountant about that. But usually the easiest place to start is just buy property in your personal name, and then there's no double taxation. But there are corps you can set up where you avoid double taxation. So you get a credit for the tax you pay in the US, so you don't pay extra tax in Canada, or not that much extra tax. What's the best life advice for a financial advisor at a fee-only firm? I get paid solely on salary. Nice. That's the best kind of financial advisor you could possibly have, because the rest are just sneaky slime balls, insurance salesmen and mutual funds salesmen. I worked at Freedom 55, not to throw any shade to them, but I did a lot of research when I got my licenses, and almost all of them, I had to quit because I literally was not a good fit in like shoving insurance down people's throats when the numbers don't actually work to benefit them. It benefits the agent. So I'm glad to hear that, by the way. Fee-based is the best way to go in most situations, especially if you're a more well-to-do person. You should not be on commission with your agent. But I guess best life advice, deliver value for people, for your clients. Go above and beyond to deliver real value for people, and you will be paid commensurate with the value that you provide. In the business world, in the entrepreneurial world, if you deliver value find high-quality people and deliver high quality value to those high quality people who are basically wealthy people or connected people, and it will come back to you in spades. That is the best life advice I can ever give anyone. Produce value. Find ways to create value for people that matter. That's it. You'll be rewarded. Top tip for screening tenants. If a tenant is willing to offer me their bank accounts and credit card statements, that's all. Every time, and you technically can't require it, but every time a tenant has showed you how they spend their money, if they have major savings, if they have great consistent income, and they have good spending habits and the ability to delay gratification, I think I have never placed a tenant, when I used to place tenants, never placed a tenant that wasn't good, that offered up their financial information and showed that they were good savers, had, good spending habits. Fact. That's probably my best screening tip, is that right there. Is just good financial habits tend to always lead to good tenants. Not saying that there aren't good tenants that don't have good financial habits, but by and large, that's been the number one leading indicator of success. And that's hard to find sometimes if you don't have an A-quality property, but you gotta wait and search for it. Yeah, I mean, that depends. How much does someone need to retire? Depends specifically on how much they spend. So if you spend $100,000 a year, 25 times your annual spending is how much you should have to be safe in retirement. Like if you're just planning to be like, I'm not working anymore, then you would need to generate a 4% withdrawal rate from your portfolio, which is 25 times your annual spend. So if you spend 100 grand a year, you need $2.5 million to retire. If you can live on $50,000 a year, you can retire on 1.25 million. If you need 200 grand a year to live, then you need like $5 million in retirement to be super safe. Like if you have real estate can generate higher than a 4% safe withdrawal rate. If your entire retirement is in cash flowing real estate, I could say an 8% retirement rate could make it happen for you, because again, you're managing the portfolio yourself. You're putting time into that real estate, so you're able to get a better return, and therefore you can withdraw at a higher rate without depleting the capital and allowing the capital to continue to grow higher than inflation. So the 4% rule allows us to do that, net of inflation. But yeah. The problem with doing renovations yourself, Will, is just a bad use of your time. Like pretty much most renovations can be done for under $50 an hour these days. So you're valuing your time at less than $50 an hour if you do it yourself, which is fine. Like a lot of people make $50 an hour at 40 hours a week, it's $2 grand a week, so that's 100 grand a year. A lot of people make less than 100 grand a year. I think it's like less than 15% of people that actually make over that. So if you're in that top 15% or aspiring to be in that top 15%, eventually you want to move towards not doing the work yourself. But yeah, it's a great way to get started too, to keep costs low and to get things done. I intentionally put my drills and hammer away because I don't value my time that low anymore. I get someone else to do it out of sheer principle. Force myself to do other things that are a better use of my time. Unless I enjoy it. Like occasionally I will do some renovation work just because I feel like it around the house or whatever. Okay, I think I've answered almost all the questions, but I'm way past my time. I'm gonna put my kids to bed. I'm sorry, guys. Last question. I have average salary in Southwestern Ontario, decent amount of Bitcoin, one single family house, no stocks, 60,000 Canadian to deploy. What would you do? Well, you already have a good crypto exposure, so maybe you have some sort of competitive advantage in that space and you understand that space, so maybe you should keep investing in that space. I don't know. It's really hard to give you advice because I don't know you, right? But there are some deals in real estate right now, so you might be able to get a really good cash flowing property and negotiate a great deal on that rental property right now in Ontario. Southwestern Ontario real estate is kind of flat right now, so it's really a buyer's market. I don't know, I think I missed. Nim James says, I was not born in Ontario. I'm super familiar with the area. My full-time job takes the majority of my time. I cannot take time away to actually focus on other activities. So for you should probably invest in passive things like, a stock account or something. Lending, crypto, active stocks, or passive. Just buy the indexes and don't look at it. That's a nice passive way to get like a 10% return a year. Some years you do better, some years you do worse, but on average you make 10%. It's great. I mean, there's nothing wrong with that approach. If you were trying to do real estate and you can't spend the time to manage it properly, you could be sued by tenants for not responding. You can end up at the landlord and tenant board in court. I've had it happen. Being a landlord, an absentee landlord, will result in very bad things for your business. So, yeah. There's also just partnering with people too. You could, find fund like hedge funds, get them to manage your funds. If you have a minimum couple $1 million, they'll take your money in and manage it for you. Try to beat the market for you. In real estate, you could partner with someone. What is the minimum? I'm like $500,000 at least to even have a conversation for it to be worth my time. But I want to work with accredited investors for the most part. So that's where, right now, until I have a fund or something established, it makes no sense for me to take on capital. There's the small amounts, right? So yeah, and partnering with someone makes a lot of sense. Someone who's an expert who can, achieve greater amounts of return than you can, and even net of at least it's passive for you, and net of the splits with the partner, you still end up ahead because you didn't have to put any of your own time in and you didn't lose any money, you made some. Potentially better than the market because you're using leverage to increase your overall return. Thank you so much, everyone, for watching, and I'll see you guys next week and on Instagram live at Mike Rosehart and on Facebook on Mike Rosehart. Look for the little blue check mark beside me on Facebook. On Instagram, I have no blue check mark, so just look out for all the fakers. There's a lot of fakers these days. Great income. Sounds great. Let's have a chat. The best way to get a hold of me would be ivyelitere@gmail.com would be the easiest way, I think, to get a hold of me, or on Instagram at Mike Rosehart. It's probably the easiest way. Hit me up in the DMs. All right, everyone. We'll see you guys next week. Remember, the secret to unlocking a wealthier you is to spend less, earn more, and maximize returns on the difference. Thanks, everyone. Have a good day.